Welcome once again to another futures video. Now I'd like to show you a little bit of information in regards to the Standard & Poor's 500 Index Futures Contract. And this is just meant to show the nature of carrying costs per unit for a financial futures contract. Now, the S&P 500 Index Futures Contract is a cash-settled contract. In other words, there is no delivery mechanism associated with this contract. So, at the open on a Friday, when the futures contract is having its last trading day, the price of the futures contract is set equal to the price of the cash index. The margin accounts for longs and shorts are once again marked to market, and then that's the end of the game. And then you have likely a winner and a loser. And so that's the nature of the S&P 500 futures contract. So let's look here. Let's suppose we need to have the stocks that constitute the S&P 500 in a month or so. Let's say we just in 1 month we'll need to have exposure to the S&P 500, long exposure. Now there's at least two ways of getting that. One would be to right now buy a security that mimics the performance on the S&P 500, like an ETF, an exchange traded fund, like a SPDR, SPDR, S&P Depository Receipt. And so we could just, and we'll call that the cash S&P 500. It's really an ETF, but we'll refer to it as the cash S&P 500. So one thing we could do, we could just buy, we could buy that. And of course, if we bought that index fund, we'd then be, having an expectation to receive dividends. So the dollar return that we'd earn in this strategy, we'll call it strategy 1, this little tilde up here, this little wiggly line means it's a random variable, is going to be equal to the value of the S&P 500 index at date 1, which is also a random variable, minus the S&P 500 index value right now, plus a dollar amount of dividends that we assume we'll know the amount of. So this is the dollar-based return we earn if we just bought the SPDR. Now, a second way to have exposure in a month is to right now take a long position in an S&P 500 futures contract. In that, we call this strategy Roman numeral 2, and the dollar-based return for this strategy, which is a random variable, is equal to the value of that futures contract at date 1, which is a random variable, minus the value of the futures contract right now, and that's a known value, plus the risk-free rate of interest, the yield on appropriate maturity treasury securities, multiplied by the current value of the S&P 500. And the reason that is there, that it represents interest income, the reason that's relevant is that if we're going to take a long position in the futures contract, we don't have to go and buy the SPDRs now. We don't have to buy the ETF now. That money that we would have that we used up here to buy the SPDRs, the cash S&P 500, down here we can just put it, invest it in treasury securities and earn some interest income. Okay, so at delivery, the value of the futures contract, as I mentioned earlier, will be set equal to the value of the S&P 500 index. So this term right here and this term right here are identical. It's a cash-settled contract. And that means this value right here will be equal to this value right here. Interesting. That implies strategies 1 and 2 are equivalent in risk because each strategy depends only on the uncertain date one values of the S&P 500 index at date one and the value of the S&P 500 futures contract at date one. And since this is set equal to this on the last trading day, the implication is that strategy 1 and 2 should earn the same return. Okay? Strategy 1 and 2 should earn the same return. So that means the return from strategy 1 is equal to the return from strategy 2. Now down here I'm just plugging in the right-hand side of strategy 1, and then here I'm plugging in the right-hand side of strategy 2, right? And then you can see we just, since this is equal to this, we just cross them out, and then we algebraically rearrange it and solve for f sub 0, which is the value of the futures contract right now at date 0, when we take a position in the spot asset, or maybe we choose to take a long position in the S&P 500 futures contract. And here we see that the value at date 0 of that futures contract is equal to the value of the S&P 500 right now, plus the appropriate risk-free interest rate times that same value of the S&P 500 minus the known dollar amount of dividends. Now I'm going to state that same equation here in terms of a dividend yield on the S&P 500. And so here we have the value of the futures contract at date 0 is equal to the current value of the S&P 500 plus the risk-free rate times that value minus D, which represents a dividend yield, times the value of the S&P 500 at date 0. And then we notice we have one common term, and that is S&P 500. So the futures contract value at date 0 is the S&P 500 index value at date 0 times 1 plus R minus D. Sometimes this is written as the value of the futures contract in equilibrium at date 0 is the date 0 value of the S&P 500 index plus the value of the S&P 500 index times the risk-free rate minus the dividend yield. And so here we see a familiar cost of carry model. The value of the futures contract equals the value of the spot asset plus carrying costs per unit. And what's interesting is that there are no insurance costs, there are no transportation costs, there are no storage costs, because it's a financial futures, and it's just the interest rates that are relevant. And in this case, we see the cost of carry ends up being a net cost of carry, because when we buy the ETF, the spot S&P 500, we are entitled to earn dividends. So this is interesting in that this relationship, the relationship that ties the current value of an S&P 500 index futures contract to the value of the S&P 500 stock index, is dependent upon the difference between risk-free rates of interest and the dividend yield on the S&P 500. So this is just a full carry pricing model for S&P 500 index futures. All right, now let's look at let's look at an interest rate future example. Before I do, I just want to make a simple observation of a term, and the term is implied repo rate. And you need not be concerned with the subscript upper and lowercase t's. Just recognize that an implied repo rate is the value of a futures contract minus the value of the spot asset divided by the value of the spot asset. In other words, the implied repo rate is the rate of return that we will lock in if we simultaneously buy the spot asset and take a short position in the futures contract. Once again, the implied repo rate is the rate of return that we lock in if we simultaneously buy the spot asset and take a short position in a futures contract that has that spot asset as the underlying asset. Okay? So now let's look at an example. This is short-term interest rate futures. Now this IRR is not the internal rate of return, but rather the implied repo rate we just saw. So if the implied repo rate, the rate of return we lock in if we simultaneously go long a spot asset and short a futures contract, if that implied repo rate exceeds the actual borrowing rate, that means, hey, we're earning more than we should be in equilibrium. In other words, the futures price is too high. The futures contract is overpriced. We're earning too much of an implied repo rate because it's greater than the actual borrowing rate. Well, if the futures contract is overpriced, we're going to short the futures contract. And we're going to hedge by going long a spot asset. So here's a cash and carry arbitrage series of transactions. At date 0, we go short a futures contract that has a delivery of date 90. And the idea is at date 90, we're required to then deliver a treasury bill that at that point in time has a 90-day life. So again, we take a short position in a date 90 futures contract, and that futures contract requires a delivery at date 90 of a T-bill that at that point in time, date 90, has a 90-day remaining life. So you're not surprised the next thing we do is we buy a 180-day maturity T-bill. So we're short this futures contract, we're long this spot asset. Now we jump ahead to date 90. Well, we've got this obligation. We were short the futures contract, so we deliver per our obligation here. And fortunately, we have a T-bill that now has a 90-day maturity, because 90 days after we bought this one, its maturity is 90 days. So we deliver the now 90-day T-bill against our short futures contract, and we get paid. We pay back the amount of money we borrowed over here to buy the 180-day T-bill and the interest, and we pocket the profit. Okay? And we're guaranteed to have a profit because the implied repo rate exceeded the actual borrowing rate. Now, let's look at the opposite, a reverse cash and carry. Of course, if the implied repo rate is less than the actual borrowing rate, that means we're not earning as much when we simultaneously purchase the spot asset and go short a futures contract on that spot asset. So if the implied repo rate is less than the actual borrowing rate, the implication is the futures contract is underpriced, therefore we'll go long the futures contract, and we'll take an opposite position in the appropriate futures contract. So with this reverse cash and carry arbitrage using treasury bill futures, at date zero we go long a date 90 futures contract. Okay. The second thing we do at date 0 is we go short a spot asset, a 180-day T-bill. We go short a 180-day maturity T-bill at date 0. And then we get some money and we invest those proceeds. Now jump forward to date 90. Well, we have this long position in the futures contract, so we're obligated to take delivery of a 90-day maturity T-bill, and we do. And then we use that T-bill to immediately cover our short here, because the 180-day maturity T-bill, the short position in the 180-day T-bill that we took at date 0 will now have a life of 90 days. So again, we take delivery per the long futures contract and cover our cash short position. And we pay the delivery price and we pocket the profit, and we know we'll have a profit because the implied repo rate was less than the actual borrowing rate. And that's all I have for these examples of financial futures. Thanks for watching.